Okay, I want to thank everybody for being here. This is being recorded for those who are not able to attend live. We're having two presentations this afternoon. The first is on intraday trading, commonly known as day trading, and the other is on swing. Even though I use futures charts for explanation on my day trading philosophies and chart patterns, they would apply to stocks as well. All right, so without further ado, let's get started. One of the first things I wanted to explain my chart settings, what I actually use and how I use them will come out during the presentation. But there are a few guiding principles here. One, keep the chart as clean as possible. If it gets messy, it gets confusing. So choose a time frame. They can be time-based, trade-based, or price-based. And of course, obviously, I'm choosing the price-based, but time-based would be obviously based on, say, a 1, 3, 5, 15-minute chart, and goes along with the same as saying a daily. Tick-based would be something like 377, 233, or whatever number that strikes your fancy that seems to work for you. I've used range and now Renko charts. They basically only draw and complete a candle when the price actually moves up or down a certain number of ticks. Depending upon the instrument and the time of day, those will actually change for me. And we'll go over that. I want to minimize the number of indicators. I want to ensure that they add value to my trading before I actually add them. And I want to make sure that I have no duplicates. How many or which ones to add, again, is a personal choice. But again, going back to line number one, keep the chart as clean as possible. So make sure it's adding value and great value to your trading. All right. For what you're going to see here is you're going to see Renko bars. Again, like I said, in this case, it's a Unirenko 6, 10, and what it is number of ticks is 6. So each one of these candles is 6 ticks large, and we will get a reversal candle drawn when it moves more than 10. So you won't get the reversal here until it actually goes 10 in the opposite direction, then it picks up 6. I have 2 moving averages to help me visualize the trend. They are, I'll have to remember, I think it's the 8 and the 17. Hold on one second. Let me bring up the indicators here. I'm surprised that I didn't catch that earlier. Yeah, the 8 and the 17. And what it does is it fills in kind of a reddish tint when it's when the fast moving average is below the slow, basically showing you're in a downtrend, an established downtrend. And when you're in an uptrend, that's blue, light blue, and that's when the fast moving average, the 8, is above the 17. I use an R squeeze for momentum, and you'll use swing levels and trader pivots, and we'll go over those as we get into the charts. All right. I've done a significant amount of study of candlestick chart patterns, and I've narrowed it down to just a few that I need to know, because there are all those little esoteric ones that kind of off the wall patterns, and they all have funny names. Once I got to about 5 or 6 at work, I didn't need any more. I found that having a bullish and bearish case out of about 3 different sets of patterns is all I really needed to do the trading. So I want to make the market prove that it wants to go in the direction that I have a hunch it will. Okay? And I want to increase my odds of it going that way, and these patterns help me do that. So these favorite patterns apply the same as any trading, anything that can be plotted intraday or even on a different time basis, they apply. Well, the first breakout and breakdown will usually be retested. And I will emphasize the word usually. It isn't always. If the market is in steep sell-off mode, it'll break through a support or resistance level and just keep on going. All right. But during a regular trading session, these usually break the level, come back up and retest the level, and in fact go a little bit on the opposite side and then fail again. And what I can do is I can show you the examples of that. So I like to enter on the second move so I don't have to take the heat on the pullback or bounce. And my target or targets are basically at prior swing levels. So at least my first target is going to be at a prior swing level, and more than likely, unless we're at all-time highs, yeah, their additional swing levels are going to be further and further to the left, and they'll give me an idea of how far it might run and where I might be cognizant of some sort of sign of a reversal or the run is done. And to me, managing risk is the key to success. You need to make sure that you have a good reward to risk ratio. You're not just buying willy-nilly, that you have a decent profit potential, and that you have a decent distance between your entry and a target level, but you start with the stop. The stop has to be what you can afford to lose. And so therefore, in day trading, in swing trading, normally I'm looking for 2 or 3 to 1 to a target 1, or at least a 1.5 to 2. On intraday trading, I could even take as low as a 1 to 1, but I won't go any lower than that. I'm usually shooting for about 1.5 to 1. The way I'd make the profit is by having a higher batting average. All right, let's look at number 1, the Zig Zag or the J hook. It starts with a strong move up, and then it does a bit of a pullback, and then we resume the run. So ideally, you'll have an up thrust that breaks through a resistance level and then pulls back. Now, some people have asked in the past, so, wait a minute, how about these right here? Why didn't you include that? Well, it's just, did I assume that this was all part of one up move? Yes, primarily because the moving averages here and the width of the channel between them stayed fairly constant. As versus over here, it actually contracted quite substantially. It's noticeable, and that's because we only had 1 or 2 candles on the pullback on the move up, whereas over here we had multiples. I also note if the pullback is to a new support level, or in this case we had the wobbling here back 3:30 time frame or so, and we pulled back to about the top of those and established a support level, a new support level. So what I would enter is on the second move higher. Aggressive entries need to make it break to a new high, but could potentially start as low as here about 74.96. In fact, that's where I like to go, because then my stop is really a lot closer. Does that mean I'll have more failures? Yes. But what that means, though, is that if it does continue, I know where my first target is, the prior swing level, and I can usually get a pretty good solid run there and get one off the table, put money in the bank, and then I'm playing with house money. And here we go. It's a blown up picture of that chart. One could say, let me get my crayons here. Let's do this. Let's pick up a different color. Blue on that background's not going to work as well. Color, magenta. All right. There's the swing level, the prior swing level, and we broke through there. One could say that there's a swing level you could go long on a breakout here. Because we had another swing level just above this one here, and my stop would have to be god awful lower. I would choose to pass on this one. I would even choose to pass on this break of this one here because we had no logical, technically supportable stop level. You could use volatility stop dot, you could use a moving average or whatever, but there's no, it has not shown me at a price level that it wants to support. Whereas in this area right in here, we're sitting right on top of that prior swing level. So I know that this is probably a good swing level. Now, where am I going to have to do? I'm going to have to wait probably until I get a break because it did the move up first. We could possibly have been faked into this one before. Stop was still down here, and it came back. But we broke out, we came back. There's a lot of zigzags around there, and you'd have to, we have to really, it's kind of an art and not a total science, trading is. So, assuming you got in, how long or how far is this puppy going to move? Well, the move from the breakout level here to that level right there, well, actually, let me do this again. Didn't draw it exactly right. This move to that area right in there is a certain number of ticks. The move from here to here is about the same. It's called a measured move. So these two are equal. In fact, the vast majority of the time, stocks will and futures will move in three waves, and the first wave establishes the direction and the order of magnitude. The second continues that direction, and its order of magnitude is 1 to 1.3 times. It's 1.382 is a Fibonacci number. So I found that a lot of these from the breakout levels, I'm not necessarily talking about all the way down here, but from the breakout levels to where it pauses is a level, and the next one is approximately 1.382 times the one below. It's easier for me to just look at a measure move 1 to 1 and a little bit. So I look at it to move, in this case, it was 72.83 or 4. We went to 72.92. That's about 10. And I would expect this one from about 88 to move to 98 or so. And sure enough, it moved to 0.0. So 98 on 88 plus a little bit. And when I get to round numbers, I tend to shoot to take money off the table and be aware of that as a possible reversal point. And at the first sign of trouble, exit stage left. Okay, let's go to the next pattern. Slide. This is the same zigzag or J-hook pattern, but it's inverted. It's to the downside. Note the support and resistance levels that we've got here. Okay. We basically have a support level here. Interesting. Haven't seen any negative reaction in the markets yet, in the futures. And then we went down and established a level. We bounced and went down on the second time. So once we broke through that level there, I'm looking for some sort of bounce and then move down through that level again, and then go short from here to here. However, okay, break the bounce and enter on the second move lower. Okay. Sorry, I got distracted with the futures there. One of the things that I have here that you'll see that unless you guys want to spend about $1,700-1,800, you will not have this cross with the dots. This one says that you're about to break that swing level, and you should go short at this level about 73.79. And the first dot is target 1, the second slightly larger dot is target 2, and the third one is target 3. Actually, I traded this on the breakdown using that. It was an aggressive trade, and you can see how the entries were here. Took it off at target 1 over here after the bounce, had to take a little bit of heat, and then made to target 3 and a little bit. 73.68. Nope, right there at target 3. It went a little bit further than my target, but that's fine. Could I have trailed it? Let's look at that. Let's look at the possibility of what would happen if I had trailed that as a stop instead of just taking the target. Well, it goes down, it goes down, it goes down, it goes down. And my stop would have to be up here. In fact, this move, this is 1946 to 1947, 0946 to 0947. We're talking a little over 1 minute here, okay? So it went down quickly. Would I be able to lower my stop quickly enough and judge it? I would make the case that most of the time I'm actually going to, excuse me, I'm going to actually have to stay ahead of it. And let me show you one thing that I should have pointed out. These dots, the volatility or stop dots, they are trailers. The green ones are created and manipulated by the trading system. The orange ones are the volatility stop. Okay, and in fact, if I had used the volatility stop for my stop out, I would have stopped out somewhere around 73.67.5. Almost exactly where I ended up getting out, and where this vol stop dot, the target dot over here was 73.67.5. I've noticed that a lot of the times if it meets your target, go ahead and take it, because you're probably going to, because of the momentum to the downside, it will get a reactionary bounce, and you'll probably get out at about the same time, and you won't have any, I'll say, angst over whether to take profits or not. All right, now if you don't have the calculations, you can still do your own on either the first break of a level, second break of a level where you get a retest, and in fact, you noticed that when I entered, it was not on the very first, it wasn't on the first break right here, where they said I should go short. I actually entered on the second down where it broke. 73.76 was actually down here. It proved to me that it was going lower. It did basically an Oreo pattern. It's a negative. Two reds, two down, sandwiching an up candle. And a break of that level after it closed was my idea to short. No matter what this system said over here. Okay. So even though I have the system there nominating and candidate shorts or longs, I still follow my patterns. Pop out of the box. Pop out of the box is basically a consolidation. It's a trading range with well-defined tops and bottoms. Sometimes they're very narrow, which is good. Sometimes they're very wide, which is not as necessarily as good. The longer it continues, the greater the energy of the next move. So the longer this thing stays sideways, in this case from about, 4 o'clock in the afternoon till about 9 o'clock at night, so 5 hours. This is when Japan opens, and we had a nice strong move up. Once we did the breakout, I have the supporting momentum indicator telling me that it's curling back up, and then I have a good solid upward trend. I did get one Fig Newton pattern or a continuation pattern up here around 343, but I was only trading one contract. So once it got up there and it started showing a little bit of weakness, I sold on the pullback. Okay. Now, the breakout of the trading range should be decisive. So we're down in here, we should get a decisive break. I am not the kind of person that's going to buy the first breakout above the trading range. But most of the time, if you get a pop out of the box or that trading range, especially intraday, it'll be a fake out. It'll be trying to get you there, and you'll have 2, 3, or 4 fake outs before you actually get the real one. But one thing you're doing, it's almost like this level. Let's get here. This level right there is acting as ice. And you're underneath the ice and you're trying to chip away. And you're trying to chip away. And you're trying to chip away. Eventually you break through the ice. And you should see a fairly sharp and decisive move higher. If it doesn't move quickly in that direction, you have to be very cautious that it might not have followed through. And the target should be at the next resistance level, and you'll have to look back to the left to try to find those. All right, I should have gone to this chart. Any questions so far? Okay. All right, wet my whistle. Drop out of the box. That is a consolidation, but instead of breaking up and out, it breaks down. Sometimes it retraces, sometimes it doesn't. The target is the next, I say resistance level, that actually should say support level. All right, here we go here. I want to point out, remember we were talking about false breakouts and whatever? There's a false breakout right up here. Let's change the color on this one. That breakout right up there was a false breakout. It didn't follow through. And the only way you can, well, not the only way, one of the best ways to determine whether this is going to be a solid breakout or not, again, what did I talk about? I talked about it being decisive and it picks up momentum instantly. Well, in fact, it started right here around 10:26, and it took 4 or 5 minutes for it to actually roll over. So in the first minute or two, it did not have a decisive move. So if one were going long, say back down in here, and it starts marching up, but it just inches up one step at a time, be very careful for the first sign of weakness and potentially take profits early. All right, so now let's look at the breakdown. We did a false breakout. We did another consolidation right in here, a consolidation inside the other, just on top of the other consolidation that happened. Let me see if I can get a different color here. See what that looks like. Oh yeah, that'll work. This right in here was the prior consolidation level. Where did we pull back to? The bulls tried to hold it up around 74.75, right on top of that. The fact that it kept wobbly here made me suspect that it was going to hold. But do I go short on the first breakdown of that? Where's my potential target? Well, one target is right over here. The lows. It could be considered R1. Oops, sorry. So right in here, this this level would be a target, and I have the support, resistance, and the primary levels listed here. R1, I'd be aware of it and say that we see if we get a reaction around there. All right. And what I'm watching for in my charts is I'm looking for the momentum to go from positive to negative. Another reason for doubting this move here is that we got no upward momentum on any of those. All right. Bullish continuation. It's similar to the pop out of the box, but it's on only a 3-candle pattern, whereas the consolidations are usually more than 3 candles long, 4, 5, 8, something like that. But this is just a continuation. There's bullish and bearish, 3 candles. To the bullish side, you've got your Fig Newton pattern here, but basically 2 bulls sandwiching a bear. All right. I want a break above, and the stop would have to be at the vol stop level or somewhere below, definitely below the candles that brought you in. So in this case, I could have a stop as high as up here. When I go long, that's pretty much where the vol stop dot moves to. It starts right here, then it immediately moves up. What I do is, instead of using the volatility stop dot right off the bat, if it moves in my direction, and remember, it should be moving smartly and decisively in my direction, I'm not going to allow it to pull back much at all. I'm probably only going to give it to below that first candle when I first enter. Now, I'm not going to enter right at the top of that breakout. I'm going to give it a little bit and say, you know what, you're going to have to prove to me that you want to go higher. And so therefore, if this thing starts to march up, if I, in fact, instead of it, let's get red here, instead of it marching higher, the next few candles did this. Do I need to let it go all the way back down to this level to know that my breakout is not working? I call the stuff that we've got down here between the, hold on a second, let me get the color here. I call this right in here my railroad tracks. or the road. That right there I kind of see as railroad tracks. If you're talking about these right here, okay. Are you talking about the railroad tracks being the box, the three kind of pattern? As soon as I see these, I'm saying we're probably going higher. If I see the opposite of that, we're probably going lower. And in fact, I'm even looking at some right now on the futures charts right below. All right, bearish continuation, similar again to the pop out of the box. It's the opposite of the bullish continuation. And the target is not the next resistance level, it's support level. Okay. I want to ensure that I have a good reward to risk ratio. If if the first target level is not sufficiently far enough down, I'll pass. Now the primary pivot that I've got here, if I've got this one, if I'm concerned that this has support other than just being a primary pivot, and I look to the left, I see a lot of consolidation over there. If I'm not happy with 74.71 to 74.68 with a two or three point stop, then I have to pass. Everything is about managing risk, reward to risk ratio. All right, and in here, you can see how the futures moved smartly lower, and where did it picked up momentum when it dropped below this 74.82 where the swing dots are. We pulled down to 74.74, and I'm going to make a bet that there was something over here to the left that showed us that we were approaching a possible support level. And you see this, you could actually enter for a move lower, but I would caution you that you need to be aware of the momentum indicators. We're a long ways low. I prefer to actually get a break like over here where the momentum indicators are above the zero line and going lower versus below the zero line or at it and expecting it to go much lower. Again, you can't always have everything, so you have to determine what you're going to trade on. Are you going to trade on price? But that's what I do. But you don't necessarily have to. If you wait for all of them to align, you're going to get very few trades. If you're okay with that, that's fine. I'm very patient when it comes to my day trades. But if I get something like this and I go short, or on the opposite of it long, but if I go short here, I'm going to have a very quick trigger. I would rather take quick profits and enter with a profit and be out of the trade, sitting on the sidelines, wishing I were in, than if I were in a trade, wishing I were on the sidelines. All right, trading rules. Quit trading if you meet or exceed your daily goal. Wait a minute, so that means if I have a daily goal of X dollars or X ticks or whatever it is, I quit? Yeah. Because my journal entries have told me that once I meet my daily goal, I'm basically running the risk that the next trade or two will be against me. This happens to be that's the case. Whether it's a self-fulfilling prophecy or not, I have no idea. But when I meet my daily goal, I quit. I move on to another instrument, or I move on to honey-do list, or I move on to playing golf. All right. Exceed the max daily loss limit. You got to know when you're not in sync with the markets, when you're out of sync. When you're out of sync, you need to stop. The old stop trading if you exceed your maximum daily loss limit, which could be less than your daily goal limit. In fact, it should be. Meaning less in order of magnitude. So if you had a 500 daily goal limit, maybe your maximum loss would be only 300. The reason that's there is because it triggers you to say, you know what, I'm not in sync with the markets. I need to reset. So I'm going to walk away and I'm going to live to fight another day. If you continue to trade, most of the time you're not going to get back to even. You're going to only dig yourself a deeper hole. That's what I've seen from many of my trades before I develop these hard and fast rules, or from others that I see come in for coaching. If I lose 3 trades in a row, your number could be 2, your number could be 5. But if you have multiple losses, you're out of sync with the market. That kind of goes along, even if you haven't hit your daily loss limit. If you're not winning on the trades, you're expecting it to go in your direction, whether up or down, and it's not doing that, something's wrong. And it's not the markets. The markets are right no matter what they do. So I've developed these rules to maximize my gain and minimize my losses so I can continue to fight another day. All right, let's go into some chart examples. All right. And this one, we had a break of the top. This is kind of a consolidation pattern. On a breakout, momentum is coming from below to up. We've had a crossover of the 2 trend indicators, the trendinators type of stuff. Went long at 24,585. Again, plus 29 ticks to the 2. I think I only had, because of the markets, I only had 1 contract. So I exited at target 2 based upon the trading system that I have here. And it got 29 ticks and I was happy. Unfortunately, it kept going for an additional 40 ticks up. If I'd had 2, I could have gotten out at target 1, which is less than that, and trail stopped and got most of it. That's why when I suggest trading, you trade so you can scale out. So whether or not, if you're trading futures, you've got to be able to trade in multiples of 2 or 3, and when you're in stocks, well, you can, if you bought 100 shares, now you can scale out 50 because the commissions are now 0. All right, but in futures, they don't have a 0 commission anymore, or yet. I don't think they will. All right, so following the rules, the breakout, first level stop was down about 1 candle or so, and then you trail stop it up, it hits your target, you take the money off the table, and I have 2 volatility dots, one a true volatility dot and one a trailing system by the trading system I have. Okay, here we go where we have a breakdown below the prior swing level. It penetrates below that a little bit to suck people into the short side, and then it runs up against them to try to shake out the weak hands. People who have extremely tight stops are going to get shaken out right here, but I entered here. It went down, moved up, a little bit of a hook, and down. What also is there is, if I can get this color right, there's a continuation pattern. So I'm combining the breakdown below and retest with the second time through and the continuation pattern. All of those are starting to line up, and I feel more confident in that. And then you can just keep going, and keep going, and trailing it out. I'm not sure why I exited at 24,228. I have no idea. It may have been the fact that it got down to 220 and then bounced, and I got out over here. And that's probably what it is once I had established a number of ticks, then once it gets further and further extended and we get the momentum to the extreme, you've got to be very, very cognizant of a bounce and a quick bounce against you. All right, here was an entry on a zigzag pattern. It went up, it changed character. It did not change until we had the crossover over here. We had the momentum going lower and going lower. We could have kind of wobbled around this level over here, and then we had continuation pattern and a continuation pattern and then a break. All right. Where did it run to? It ran to one of the pivot levels, S1 in this case, and reverse back. I could either use the nominal stops, or I could say, you know what, I'm going to use the second candle back. Now, I'm not sure exactly when I exited at 16,882. I guess I probably used the trading system here. And the fact that it went down an additional few ticks, okay. All right. Here's an entry on a breakout. Now this is kind of a ragged, move up, pull back, and then now a start of a move up again. Rapid move. Take it when it presents itself. R squeeze moving up. It ultimately ran 37 ticks. I only got 22, but I'll be happy. I took the high probability. I got move number 1 here. And if you look at it, there's move 1. There's move 2. This was not exactly a measured move. It was close, but from down here to up here was, this is crude oil. Crude oil, I tend to take quicker profits because they gyrate all over the place. 22 ticks on one contract is $220. So again, this was after the oil announcement, I'm sure. And it moves up. So this was not a measured move. It kind of went. The first moves in oil are usually the strongest, and the second and third waves get progressively weaker. Just know your market. Overnight trades, they tend to move slowly. Break of the primary pivot level, momentum oscillator going down. Through the zero line, knowing that it's going to go lower. The stop was 27 ticks, so I only had one contract. The target number 3 was 34 ticks. That one was a pretty easy one because if you notice right in here, what times are we looking at? That move down was right here was all within 1 minute. 1 minute. And the full move was less than 2. So they can move sharply in your direction, hopefully, or against you, so you have to be careful. Another overnight trade, I'm not going to go into great detail. I have or will post each of the slides here on our break. We're going to take a break between the two. And basically it's the same thing. Consolidation here, breakout, then you have to manage the trade either via trailing stop or targets. Again, pop out of the box. Here's our box. We broke out. Got our momentum going higher. Enter. Boom. We've actually seen this before at the 303, 343. Okay. And that's the last of the slides. Do you have any questions out there of any sort on any topic that we've covered so far? We're going to go into the swing level after taking a short break, but I want to give you an opportunity to ask questions here and for me to take a short 5-minute break as well. Let's see if we have any typers in there today. I see Walter and Steve. Hi Steve, how's it going? Oh, you're welcome. It'll get a little more interesting for the swing traders here in the second one. Okay. I still see some typing going on, so I'll wait for a little bit here. Yes, Steve. All of these are recorded. They're over in the archives. Let me see if I can bring that up. So the business about the PM throwing people out of the meeting may not have been true after all. Okay, remember login. Remember me, let's go. All right, I'm logged in. Webinar replay. Under resources, webinar replay, and you'll see all the presentations. All right, let's take ourselves a break until the top of the hour, 2 p.m. So let's take a 10-minute break, and then we'll get started again. All right.